Hey everybody, it's Pete. Good morning. Welcome to a new episode of Stocks for Breakfast. Today we're going to talk about my favorite topic. Your favorite topic is how to make the stock market make you money. And we talk about this a lot in our community, which is my mission is to make you the reason you make money. It's great to watch YouTube videos. It's great to buy courses, and all of that builds you a great foundation. If you don't have any foundation at all today, I'm going to give you the path that you should look for, whether you enroll in my course or my coaching program, somebody else's coaching program, or you attempt to do it on your own. I'm going to give you the steps that are the absolute positively time-tested way of getting from I'm looking at stocks to buy to reliably making the stock market make you money. Now, there's steps in between that you have to get good at, but isn't it a lot easier to at least know the steps? Because then you're like, okay, I got that one done. Now we move to the next one. Let me move to the next one. So we have a list of maybe 7 things to consider, and they're very simple. And here's the thing that I want to get across to you. The actual part of trading is the easiest part. Everybody puts so much stress on buying and selling and that kind of stuff. But what I'm going to walk you through right now is what happens before you even decide to buy a stock. If you do this part first, which is incredibly simple, which is first mindset, second is deciding on risk, and then the third set is your edge. So first you have to think like a champion. Second, you have to understand what it means to put your money in harm's way. So if we want the stock market to make us money, we have to understand that there's risk and there's reward. So we're going to talk about that in a minute as well. Then we're going to talk about why you should put your money in harm's way. And we call that having an edge, or in other words, probabilities of it moving in your favor. And then the last part is we're going to talk about entries and exits. And that's probably the part that most people jump to first, is like, just tell me where to get in. Just tell me where to get out. And that's great. You'll actually be able to mimic somebody like myself, but we don't do things that way. What we try and do is we show you exactly what I'm doing. I tell you why I'm doing what I'm doing, and then we get repetitions in so that you become the reason that you're making money. And there's really no sweeter feeling in the world than having that feeling of conviction that you expect to make money every day. And that's really what you're going to learn in the next, let's say, 7 minutes. All right, so stick around. We'll be right back. I just want to make sure I pop this up on the screen. Okay, so as with everything that we do in these videos, these are for educational purposes only. It's my mission to try and help you understand exactly what you're doing. And if we do that, I'll have a really good day, because I know trading can drive you crazy sometimes. Sometimes the market is exploding. Sometimes the market's going straight down. Today, we're going to give some context to how to really dig in and understand what's going on and how to make trade decisions with absolute conviction. So the next time that you buy a stock, you feel 100% that you're making the right decision. So the first thing we're going to do is we're going to work on over. And the first concept that we're going to talk about today is probabilities. Probabilities, by their very definition, and this is very important. Remember, we said the first thing is about mindset. Before you ever buy a stock, you need to understand that when we trade, when we try and make the stock market make us money, when we go in there to buy stocks, our job is to put our money in harm's way because we believe there's a good chance. That's the key word there. It's a word that so many people ignore. We believe that there's a good chance it's going to move in the direction that we believe. But what is that also saying? That's also saying that there's a possibility it might not. So right out of the gate, the very first thing that you need to internalize, the very first thing that you need to believe before you hit that buy button and decide to buy stocks, you need to believe that probability means there's a good chance it could move in your favor, but there's also a chance it might not. So think about this. Before you ever buy stock, you need to be looking and planning for both sides of the trade. If it moves in my favor and pauses, do I add to that position? If it moves in my favor and pauses, do I get out of that position? That's a part of reading the market. If I put that trade on and moves against me, which is a possibility, what do I plan to do then? That's what it means to have probability. So everything that you ever could possibly learn about trading stocks, buying stocks, and having the stock market make you money, the first thing you need to internalize is everything we do is based on probabilities. That means something is probably going to happen, but you need to know what you definitely plan to do. So probably happen, definitely do. That's a big part of trading. Now we're going to head on over to the second part. Okay. So part number 2 is defining winning. Now this changes for everybody. When I say this changes for everybody, what I mean by this is you might have a part-time job and you're trading stocks on the side. Stock trading might be your full-time job. You might have a full-time job and you're maybe making 1 or 2 trades a month, which again, none of those is right or wrong. It simply means that you need to know what kind of trading business you plan to open. Are you looking for cash flow where you need to make money every day? Are you looking for weekly cash flow? Are you looking for monthly cash flow? Or are you looking to fund your retirement account and just see your account grow slowly over the years? Again, none of them are right or wrong. Everybody comes to the market with different resources, different goals, different objectives, different education, all of those kind of things. So you need to know, what does winning look like for you? And there's a reason for that, because that's going to define your trading plan. That's going to define how long you hold a trade. That's going to define what kinds of stocks you trade. That's going to define what kind of volatility you should handle. And volatility means how fast and how quickly stocks move over a certain period of time. We're going to get into what that means in a second, but I want you to sit back and think, if I start trading stocks, do I need this money tomorrow? Do I need this money in the next 30 days to pay the mortgage or the electric bill or the rent? If you've never traded before, I'll tell you from personal experience, that's pretty darn hard to do, to just go in there and start trading stocks and making money right away and pay your bills. What we're going to outline today is the steps, but you need to learn the skill. We have to respect the fact that trading is a skill. It's not A plus B plus C. It's a skill of making those decisions, which is why we started out with the mindset being the most important thing. So I need you to write down now, again, take your legal pad, write down, what does winning mean for you in the stock market? What exactly does it mean? What kind of profits are you going after? Now, I know it sounds like, oh, I want to make as much money as possible. Well, if you want to make unlimited upside, how much do you know about stocks and stock trading to believe that unlimited upside is what you can earn right now in this moment? I'm going to walk you through the kind of stocks that I trade. I'm going to actually give you that there's stocks that are in the news. There's stocks that had earnings. There's stocks that have what we call order flow. I personally find stocks that have order flow to be the easiest trade because there's constant, reliable, predictable, institutional attention. So that basically means the smart money, the deep pockets, people with big money and big research, hedge funds, banks, institutions have attention on those stocks on a day in and day out basis. I'll give you an example. Apple. Apple would be a stock that we might call a market stock. So it's one of those stocks that active traders pay attention to pretty much every single day. And here's a big secret about stock trading. Before you buy a stock, you don't need to be constantly looking for new stocks, especially if you're a newer trader. If you're a newer trader, you should actually have a few market stocks and really learn how those stocks trade. It becomes easier to know the probabilities when you know the stock, and that gives you conviction before you even buy the stock. So I need you to write down now, what does winning mean to you in stock trading? Okay, next, we're going to walk on over. First, we define winning. Then we define, account risk. What does that mean? What does it mean to define account risk? So you need to determine how much you're going to risk of your capital to each individual position. So I'm just going to use some round numbers. Some people are trading with $3,000 and trading with a small account is fine. Some people are trading with $100,000. It doesn't matter. I'm going to use an example that I actually teach in our boot camp. And if you want to learn more about the boot camp, click the link below the video. Let's say you have $30,000. We just keep it as a simple number. So again, don't let the numbers overwhelm you. It doesn't make a difference. So let's say you have $30,000 in your account. Now, some people will trade that entire $30,000 and allocate that buying power to one position. And there's nothing wrong with that if you have experience, if you understand risk, if you understand probability, if you understand how to make money. A more conservative way to allocate money to the market is to break up that $30,000 into multiple positions. So we're talking about defining account risk. What we're actually talking about is how much of your total capital is going to go into each position. So essentially what that means is if we have $30,000, we would allocate, for argument's sake, $10,000 per position. So you're never fully exposed to one idea. So you're actually spreading out the probability and the risk of your position because one position is not dominating all of your buying power. Now, there's two sides to that. The first side is the greed kicks in and you start to say, well, I want all of my money in one idea because if that idea is really good, I could make more money. And emotionally, that sounds correct. But logically, you shouldn't be taking that much risk. And I don't take that much risk unless you have more experience. You have to have more experience to understand when to size up, when to size down. So it is a smarter decision to allocate that same $30,000 to 3 positions. So you technically, in your defining your account risk, it would be $10,000, $10,000, $10,000. So you're spreading out your allocation of that hard-earned money you have into 3 different ideas. So remember what we talked about before with probability. Probability is it's going to happen more often than not. And that implies you need a sample size. You need 5 trades, you need 10 trades, you need 20 trades to allow the probability to work out. So whether it's 60% or 50% or 30% or 80%, probability means over a sample size. So if you only take 1 trade, you're not allowing the probability. You're putting all of your eggs in one basket. And there's nothing wrong with that if you understand what we're going to talk about going forward. But if you're just learning, especially if you're a stock market beginner, you want to understand how to allocate your money to a couple of different positions. So that is the first step. The first step is defining account risk, account size risk. So just in that example, just to give you stuff to write down on your legal pad, let's say you have 10,000, you break it up into 3 different positions, which now means that you will have 3 different possible positions of $10,000 per trade. So you can actually allocate $10,000 to an Apple trade, $10,000 to NEO, electric vehicle stock, okay, whatever it happens to be, okay? Next, we're going to walk over to the next part of the equation, which is defining your dollar risk, okay? Defining dollar risk is interesting because now let's say that we just decided we have $10,000 to allocate per position. And this is huge. I can't even describe how big this part of this is. And this is by far the number one thing that if you get this part right, everything else in trading is so much less stressful. I don't know if there's any other way for me to say this. Raise your hand if you've ever stressed out of your mind on a position where it's going up, it's going down, it's going up, it's going down. And you're like, oh my God, it's going up. I'm making money, I'm losing money. I'm making money. And your heartbeat is going up with every single part of the trade. I'm going to shift that for you right now in such a fast way that it will become the easiest part of trading for you, which right now for most people is probably the most difficult part, which is accepting risk. We talked about probabilities, which means sometimes it's going to move in our favor, sometimes it's not. So we're going to talk about managing the moments that a stock might not be moving in your favor and why this is going to instantly turn you into acting like a professional trader. We talked about $10,000. Now, from that $10,000 or the one position that you're going to be allocating, you need to determine based on your risk, your resources, your goals, your education, your training, your skills, how much do you want to risk per trade? So if we have $10,000, I'm just going to throw a number out there and let's use 2%. 2% of that $10,000. Now, what's kind of cool about this is that 2% will the dollar amount of that 2%. So 2% of $10,000 or 2% of $8,000 or 2% of $15,000. That number, that 2% is what you're comfortable risking, but that number goes up and down based on your account size. So you're actually going to be risking more as your account grows. You're going to be risking less as your account goes down. But here's the thing. Once you mentally accept what that dollar amount is per trade, that dollar risk per trade, now you've accepted that as a business expense. So that's something that's really important. Defining your risk is accepting a business expense. Now, here's the question I get all the time. What's the right number for me? What is the right risk per trade that I personally, Pete, tell me what I should be risking per trade. Well, let me ask you A super obvious question. How much do you normally make? Let that sink in for a second. If you've never had profits, if you haven't had reliable profits, how much do you normally make on your winning trades? See, trading is a business like anything else. So how much are you willing to put in harm's way based on how much money your business grows? When you try to make the stock market make you money, when you're trying to buy stocks, what do you normally make? What revenue does your trading business produce? If you don't have any revenue, that number should be maybe even 0.5%. If you're consistent and you absolutely know what you're doing, you understand when to size up, you understand when to size down, you understand how to work orders, you understand you're disciplined with taking losses, you're disciplined with holding trades, maybe that number goes from 1% to 4 or 5% because you really understand what great opportunities look like. You understand when order flow is right there and you can get in there and size up. You need to determine what number is good for you. And then if a trade should happen to move against you, like, I'm out, moving to the next trade. That was a part of my business plan. That's a business expense. I'm okay with that. I was okay with the risk before the trade, and I just take the trade. And you know what? As soon as you take that trade, you feel amazing because you did what you planned to do. You don't feel amazing because you bought a stock and it didn't make money. You feel amazing because you did what you said. Next time, it'll move in your favor. Next time, maybe it will. Next time, maybe it won't. But what's important is you know what your business expense is. And if and when you have to pay that bill for that business expense, which we call a trading loss, you just take it and you move to the next trade. I am telling you, that little segment that we just covered is by far the most important part for the mentality of successfully taking money out of the stock market over time. Because as long as you control the losses, you'll be around long enough to understand how to make money. I'd watch that again and take notes. All right, next, so defining the dollar risk. Now we get into position sizing. Position sizing is actually relatively simple. Position sizing is simply taking the difference between what we just defined, the dollar risk, and dividing that by your stop loss. And that gives you the proper share size. So what's kind of cool about this is it doesn't matter if you're trading a $10 stock or a $500 stock. You're still only risking the same dollar amount per trade. Think about that. You're never going to risk more per dollar because you've already defined how much you're willing to risk on the idea. Now what you're actually looking to do is how many shares do I need to trade? If I want to risk, I'll just throw a number out there. If I want to risk $200 per trade and my stop loss is $1 away, well, that's 200 shares. It's really that simple. If you want to risk $200 and your stop loss is $2 away, obviously it's different share size now. So you divide that to become proficient in understanding the share size. And that's kind of cool because you've already understood that you're accepting the dollar amount, you have a stop loss on the trade, and now you just take those two numbers and that gives you the share size, which kind of really takes all the confusion about how many shares should you have, because those first two parts of the prep work are literally giving you the amount of shares based on what you've already accepted on the trade. So that's actually kind of an easy part. We're going to move on from that one right now. So position sizing. Next, we're going to talk about order flow. We get tons and tons of questions about order flow, and order flow is what I specialize in. Order flow is what I do. I teach order flow and I teach tape reading, and I'm going to teach you order flow, the smallest part of order flow right now, just so you could really start to say, oh my gosh, that makes so much sense. So we're going to actually head on over to the chart, and we're going to take a look at Apple right now. Okay, so we're going to look at Apple, and we're going to take a look, and here's what I want you to visualize. I want you to look at these 2 days here. I want you to look at these 2 days here. I want you to look at this period of time here. Why does a stock on this day do this the next day? Why does it have higher highs? Why does it have higher lows? Why on these 2 days does it have a lower high? Why on these 2 days does it have lower lows? Right? Haven't you ever sat there and said, why do stocks go up and down? It's the fundamental question of putting your money in harm's way, on answering the question of why do stocks go up and down? That's order flow. When I had my trading firm in New York City in 2007, everything changed in the stock market because I was already a NASDAQ trader. I was a very aggressive NASDAQ trader. The New York Stock Exchange made some changes on the floor of the exchange where they took all the power or the responsibilities away from the specialists and the NASDAQ market makers, and a lot more became electronic. So those people came off the floor And a lot of them ended up trading on my floor in New York City. And they introduced us to the concept of order flow. And order flow is very simple. It's smart money, deep pockets, people with a lot of research doing all of that research and then allocating those research and dollars to stocks. So that's when you look at a stock, and whether it's from one day to the next, did smart money pay higher prices? Did smart money hold higher lows? Did they do that over one day? Did they do 2 days? Did they do that over 2 weeks? Did they 3 weeks? How often did smart money, how long has smart money been committing capital to the stock you're considering buying? It's shocking that that's how simple stock trading can be. No indicators, no tools, no all that possible thousands of things you could have on your screen. Think about it. Why do stocks go up and down? It's because somebody with a lot of money and a lot of research determined in the future they think that stock is going to be a higher price. Now, remember what we said all the way back in the beginning. What does winning look like for you? Are you determining that over the next day? Are you determining that over the next week, the next month, the next quarter, from one earnings report to the next? So the very first thing, and this is forever going to change what you do. And again, this is what we do in a lot more detail inside of our bootcamp. If you want to learn about that, please click down below. It's only $295 for 30 days. It's not a subscription. It's basically a 30-day coaching program with me where we do this every single day. And I actually give you my entries and exits, walk you through why and all that kind of stuff. But here's the thing. We're going to look at Apple again. So now visualize while you're looking at this, higher highs, higher lows. They were paying higher prices. Then there was some indecision. A couple of days, the stock took a pause, and then they came right back in. And if you do the same thing on a weekly chart, now you want to take a look and see how long has smart money been paying higher prices in Apple. I hope that's profound for you because that's a pretty big deal. What we just did is we just eliminated all of the confusion in the stock market and all of the things you could possibly be looking at by saying, why do stocks go up and down? Once you ask yourself that fundamental question and you take all of the confusion out of the market and say, well, people with a lot of money make commitments because they believe that stock is going up in the future. Now we just look at daily charts, weekly charts, and monthly charts and determine how long have they been buying stocks? How long have they been making a commitment? Is it 1 day, 2 days, 2 weeks, 2 months? Think about it. It completely changes the way you look at stocks. Okay. Next, that's what order flow is. The next part is tape reading. Okay. Tape reading is something that we call building an argument. Okay. So building an argument in trading simply means this. We talk about the stock market power pyramid. We talk about order flow. The stock market power pyramid is simple. And I want you to really think about this for a second. Are you just trading what your stock is doing today? Or is there a lot more money? Remember, we just talked about order flow. Is there a lot more money doing the same thing? So this is really where it gets exciting, because remember we talked all the way back at the beginning about probabilities. Probabilities means the likelihood of something happens. It's probably going to happen. But how do you know the probability? That's what tape reading is in the way that we do it. We build an argument for the idea. So here's the worst idea in the world. The stock went up yesterday. I want to buy it. That's the weakest argument in the world. You might as well just kiss your money goodbye and throw it away every day. That's a weak argument. It's an argument, but it's a weak argument. A better argument is the market's going up every day. And this is the stock market power pyramid. On the bottom of that is the foundation, the overall big market. And a lot of people call it the big three, which is the Dow Jones Industrial Average, the NASDAQ Composite, or the QQQ, if you want to use that, and the S&P 500. That's the foundation under everything. If that's obvious, you have a lot of money doing the same thing. So if we go back over to the screen and we take a look at, we'll use the S&P 500 as an example. We'll use the SPY ETF. You can see now for weeks, going all the way back to early 2020, you could see that smart money has been buying and paying higher prices for months. These are weekly candlesticks for months. You can see the same thing in the Qs, and you can see the same thing in the Dow Jones Industrial Average ETF. And matter of fact, as of this recording, we're sitting at all-time highs. That's the first part of tape reading. Is the market obvious? Okay, is the market obvious? Fine. Now we work our way up to the next layer of foundation, which is the sectors that encompass the entire market. So we're going to walk over to what that looks like right now. And I generally use this service called Finviz. It's there's free and there's paid versions. What I'm about to show you, you could do on the free version. You simply click over on groups and you'll see the relative performance. So think about what I just said. If you remember what I just said about how long has smart money been buying stocks, you're literally seeing it right here. There's no reason to guess. When you make the stock market make you money, before you even determine which stocks to buy, you want to go and see which ones are the smart money already doing something in. Do you see how we eliminate all of the confusion? We already talked about why do stocks move up and down. And now we're just going to see, well, which stocks are they doing that in right now? The market on the bottom is the foundation of the power pyramid. We go one step above that is into the general sectors of the market. And you can see here, we have 1 day performance. Let me make that a little bigger for you. Performance over 1 day, performance over 1 week, 1 month, and 3 months. So you start to get a feeling. You see over 3 months, technology. Over 1 month, technology. Technology worked its way down a little bit over the last week, and it's been in the middle. So over the last 3 months and the last 1 month, technology has been strong. And if we go back over to Apple, well, technology woke up a little bit yesterday. So what we just did is we broke down the big picture of the market. Is the market obvious? Can you look at a chart and say, wow, buyers are in charge. The market is definitely going up. And how do you know that? Order flow. You're seeing them pay higher prices over time. Okay, now within the context of the market, which sectors right now are the market leaders? And we just looked at, in this example, technology over time. Then you break that down even further, and we'll show you what I mean by that. Now you're going to look at the market leaders in the strongest sectors that are following a strong market. So if we break that down a little bit further, and I'm just going to go over here to performance, you'll see that there's breakdowns over that same time period. So let's actually go into the last month. We're going to sort this by the last month. And as we said, technology is at the top of that list. So what we just did is we went from the market to the sectors. And now we're going to break it down to the individual industry groups. So we're moving up one layer on the stock market power pyramid. And when we break that down and we go into overview, inside of the stock market power pyramid, there's going to be different industries within different sectors. So now the fast way of doing this is you want to break this down even a little further. You want to have some sort of criteria for stocks that have attention. Remember back a couple of minutes ago, we discussed institutions have attention on certain stocks and they have reliability to their probability. Okay, so we're going to break this down a little bit further now, and we're going to talk about average volume, which is attention. Now we're going to use 2 million. That's the number that I normally use. So 139 technology stocks have an average of 2 million shares. I also want to talk about average true range. That's the volatility, how much a stock normally moves from the high to the low. So we broke that all the way down to 55 stocks in the technology sector. And so now you can see here's the sector, here's the industry, and we're going to break this down by performance again. So we're just going to go by the last month just to give you an idea. And now you can see the strongest stocks in the strongest sectors that will actually end up being the stocks that you pay attention to. Very easy to break down. Now, what we just covered sounds like a lot, but it's really not. Think about it. All of the decisions at the beginning were simply breaking them down into, am I thinking in probabilities? How much am I willing to risk per idea? How many shares do I need? And that's all before you even decide. So you decide in your trading plan exactly how you want to allocate capital. Then you go into what's the market doing? What's the order flow in the market? Which sectors are following the order flow in the market? Which industry groups have leading stocks? And those are the ones that you allocate money to. I want to say, first off, thank you so much for being here with me. Now it's 29 minutes into this video. We're going to finish at 30 minutes. If you made it all the way to the end, it really shows that you have a burning desire to be the asset. Like I said, that's my mission is to help you make better decisions so you have absolute conviction that every day you wake up expecting to make money as long as there's opportunity. Some days the market's a little choppy, some days the market's awesome. But remember, that's part of tape reading is understanding when the market's obvious and how and when to buy stocks, right? So what I want to finish with is this. If you've made it all the way to the end, and this is really something that keeps you up at night, something that you know will ultimately at some point in your life lead to the free time that having the skill is really what it gives you. Once you have the skill and the control of your assets, the control of how much money you make is in your hands, everything changes. So I want to give you, I want to ask two things. Number one is give yourself a chance. Please give yourself a chance to learn how to do this, because trading is a skill. You need to understand all of the stuff that we just talked about is what goes into trading. But the last part, what happens between entry and exit, like we said, that's the easiest part, but you have to do the prep work before then. So give yourself a chance to learn how to do this. If you'd like to learn this in a lot more detail from me, I would love to have you in my community. We have the most amazing people in our community. Click the link below. If you'd like to shorten your learning curve and watch me do this every single day, join me in my community. Click the link below. If you have any questions, absolutely leave them below in the comments. I'd love to hear from you. Smash that like button. It would mean the world to me to let me know that I created value for you today. And definitely, please, if you can subscribe, hit that alert button so when we get more updates like this, you'll get alerted and know that more content is out there. So thank you so much. I really appreciate it. My name is Pete Renzulli from Stock Trading Pro. I hope you found this valuable today, and I hope some light bulbs went off for you today too, because that's really exciting. Have an awesome day, everybody.